Hey guys, it's May from Markets with May. And in this episode, we're going to talk Netflix. And at first, I wasn't going to do this. But then when I woke up this morning and saw all of the negative articles, I was like, I got to do Netflix because I don't agree. And that is despite the fact that I went into this quarter bearish and I've been bearish for a while. But even I kind of at first, when I looked at the release, had some confusions and it's really funny because you can sometimes see the dialogue between me and other people at Gurula. The only reason that I wasn't short Netflix going into the quarter or had no position on Netflix going into the quarter was really because as you guys know, when I collaborate with Gurula, they're really strong on charts and day trading. That's not what I do. I do fundamentals. Okay. And they were like, May, listen, girl, don't be short Netflix going to the quarter. And, they don't usually like kind of give me that heads up. But I was like, you know what? Fine. There's other stocks. There's other opportunities. I'm cool to just let this one sit out either way. And when I first looked at the release, it read a particular way and looked a particular way where I was like, ooh, I don't know how to think about this. But after listening to the call and really looking at the numbers, which I will show you in just a second so you can make your own decision, I was like, actually, this is a lot better than I think people are reporting it. And so let me give the quick disclosure. Past performance is not indicative of future returns. This is not investment advice. This is for education purposes only. And I really do think that since it's so easy to find the bear case right now in the marketplace, you can use this as a counterbalance to what you're reading so that you can decide what you think about Netflix. Okay, let me share my screen. 1 second, guys. This takes just a bit. Thank you for staying with me. Okay. All right. These were the articles that I found. Yahoo Finance had this guy that was a Macquarie media analyst, and he's actually usually pretty good, but he was focused on the fact that you can't just rely on subscriber growth. And then there's a bunch of other people that, because of the way the numbers read, they probably saw what I saw when I looked at it yesterday and were like, ooh, I don't know. Does it deserve to run up this much? But I got to tell you, I think that the idea that you should not care about subscriber growth at this point misses what just happened on this quarter. Because I actually think one of the many things that was my bear thesis and was part of the reason why I was always a little bit worried about Netflix every quarter actually played out and suggested a true transition of the business model to the one thing that I've been wanting them to do all along. So that is where I would stand with those. But you can see plenty of articles, plenty of analysts that came out negative on it. You got to make your own call. Okay, first let's go through what people saw. And that absolutely is a real thing, and that is profitability. So operating income down quarter over quarter. So December quarter was 631 down to 549. So it was down 13%. And then you get this ridiculous EPS number down 91%. And I'm like, what happened in between there? And it turns out this number right here, this 339, which was an uptick of 108, that's actually these Eurobond hedges. Okay. It's non-cash in nature and it's a really weird hedge. And last quarter, I was like, dude, you got to figure out how to hedge this book. Like it's not that hard. But apparently the way that they've decided to do it is using these Euro bonds, which mark very strangely. And so they got to take the mark in the weirdest possible way. So actually, I think if you're using EPS as your metric du jour, you really need to maybe do something else because that number can flip on a dime as far as that goes and help you one quarter just as much as it can in the other. And it'll especially be the case if you're using it for forward estimates and you better have a strong currency thought process surrounding it if that's the reason that you're making your call is based on earnings. Okay, so that's one of the major things. But even then, if I add back in that 339 and the 108 back to the bottom line number, I still get slightly down. So really, you still end up with down 13%. So what happened? Okay. Now, what happened was the business model where they're moving towards ad revenue. Now, how do we feel about that? First, let's talk about cash flow. Cash flow improved dramatically from last year, down 403 to 443. And that's because they have a bigger D&A charge, depreciation, amortization. So you have to add that back in. Now, this is where I think I come out very differently than everyone else in the sense that when I looked at EBITDA, I was like, okay, my bad. If you are actually turning this business around, that is a very cheap price or enterprise value to EBITDA number. Now, I have heard on more than one video, people are quoting a price to enterprise value, or sorry, price to EBITDA of 20 times. I have no idea how they get there. Because at 20 times, yeah, that would be a different story. But here on trailing EV to EBITDA, when I do the calculation, I get to 7.2 times. Here are my numbers. Operating income of 5.6 billion for the full year. This is trailing, so 5.6 billion. D&A of 14.3 billion gives you 19.9 billion in EBITDA. And then you've got 148 billion in market cap minus the 6 billion in cash, 143. And if you take 143 and divide it by 19, you get around 7.2. That makes it really cheap. For context, Google trades at 11 times and change enterprise value to EBITDA. Now, I'm not saying that it would trade at the exact same multiple as Google, but I'm just saying that even Google, I think, is a little bit cheap at 11 times. Because that's telling you how fast it is that they would create that much cash. Now, there's a couple of things here. Some people look at free cash flow. That's actually, 89 times free cash flow is aggressive, but it's not so aggressive. The one thing I would mention is that additions to content assets, because this is a media company, you look at the numbers a little bit differently. And I'm comfortable dinging them on free cash flow with this lower number, with the 1.6, because I think that what we're seeing is that you're starting to get a very strongly generating cash company, and the 3.9, which represents investments in new film, media, etc., is probably not. I'm cool to keep it in maintenance capex, which is what it means that people are doing by keeping the number this way. Okay, but the thing that I really want to highlight is, did they just lower this number 5.6 to 3.9? Like, are they just spending less and so they're borrowing from the future, realizing that it takes about half a year to 6 months after production, there's post, and then they finally launch to get these things up on the screen, so to speak. So we're really looking at this number pulling through to help us for this quarter. And here's what they answered on the call that I think is always been the reason that I like Netflix. And that is because the reason that number is low isn't because they went El Cheapo on their media. What actually happened was, yeah, they did cut some of the spending budget on films, but it was more than compensated for by the fact that they source entertainment, film, series, all that stuff internationally. And so Wednesday ended up doing way better than they expected. And then a bunch of the international films also did better than expected. Last year, Squid Games is probably the standout, but there were several others, K-dramas and different things, Singles Inferno, et cetera, that did better than they would have expected on keeping subscribers coming to the channel. And that brings me to the real reason why I think, given this valuation and given what's going on, there is something very interesting happening at Netflix that's being ignored when an analyst says subscriber obsession has run its course. And that is this right here. What actually happened on the quarter is you got subscriber growth, and that's cool, but it's the regions that you got it in that make it very exciting for me. It has always been the case that every time I look at Netflix and look at the subscriber additions, I get really depressed about the fact that they barely seem to be able to increase it internationally. And for some time, you even see at times one quarter up, and then they lose every single one of those subscribers the next quarter. And that just wasn't the case. The international subscriber growth is finally taking hold. And I think that this business model that they have now with ad spend and what they're doing is actually finally allowing them to grow out of North America, specifically Canada and the US, because Mexico is included in LATAM. And I'll show you that very clearly. Yes, they added 909 1,000 subscribers, but they did so much more. 909,000 subscribers, but they did so much more internationally, so much more, right? So now this is what I think people forget has always been the story for me, but maybe not for others. Netflix will never be in China or Russia. They will always ever be in the US. And it's really always, to me, been about growing the rest of the market, because the population of the US, yeah, you've got 2 people living in a house and then kids and stuff like that, but you don't make as much if the parents are paying for subscriptions for kids that live in college. But internationally, that is a gold mine for waiting to happen, because it is still the case that there is economy of scale in this business. There is demand for film for what the US is creating and what other countries are creating in content in countries that would not have local means to buy that content. So, like a local Latin American station is not going to have the same what do you call it? The same budget to buy and source films and the such all over the world at scale. And that's what Netflix has been. This subscriber growth that I saw internationally allows me to finally be like, all right, 156 million subscribers is what you have against a population of 5.9 million. Okay. And that to me means that all of these articles that are coming out on subscriber growth are a bit missing the picture. And hence it's why I'm so bullish. Now, usually David joins me on these chats, but I'm not seeing him. So I'll just take a couple of questions and then we'll end our Friday early. Okay. Don't forget to hit the like button. Oh, thank you. That's so awesome. It doesn't look like I have a lot of questions on it, but that in a nutshell is Netflix. And with that, we'll just end the show early. Take care, guys. Happy Friday.